If unemployment's up, inflation's down. That's the Phillips curve. You can draw it, and the Fed's using that to guide policy. The Phillips curve is garbage, and it's not a personal insult against Professor Phillips. It's the case that there's no empirical support for it. I could give you examples going back to the 1930s of low unemployment, low inflation, which we had in the early 60s. 1930s, we had high unemployment, low inflation, even deflation. Late 1970s, what did we have? High unemployment and high inflation. That was called stagflation. So I can give you examples. If you think of it as a quad chart, unemployment, inflation, fill in the blanks. I could give you all four examples: low, 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 high, high, low, high, high, which means there's no correlation. If you can have any one of them, there's no correlation. So the Phillips curve has no predictive value on its face because the data doesn't back it up. Last time I looked at a Phillips curve, it was a flat line. At least where I went to school, curves were not flat, but there it is. Now, it's worse than that because unemployment, even if you thought it was a good indicator of something, particularly inflation, it's a lagging indicator or a lagging indicator of recession, as the case may be. So let's say you're an employer, a business person. I mean, you're an entrepreneur. I start businesses. When you're in a tough spot, when revenues are down and things are slowing down, margins are getting compressed and all that, the last thing you want to do is fire people because it took a while to find them, hire them, train them. You don't want to let them go. You do everything else. Like you turn down the lights, you call your landlord, negotiate a cheaper rent, slow pay your creditors, drive a hard bargain on something. You do everything else to maintain your margins. And then only when all else fails do you start firing people. So first of all, it's a lagging indicator. You're already in the recession before you get around to firing people, number one. Number two, because you held on so long, you tend to do it en masse. It's not like I'm going to fire one person a month for the next year. It's like I'm going to hang on to all of them and then maybe, sadly, fire them all at once because I have no other choice. So A, it's a lagging indicator. B, it can turn on a dime from very low unemployment to very high unemployment within a matter of months. And if that's what the Fed's relying on, which they are, they say so. It's not a guess. They say that's what we're watching. Two things. Number one, you're not going to see the recession coming. It's a lagging indicator, and it can go from kind of good to bad almost overnight. So the Fed's, driving this way, looking out the back window, and they're probably going to wreck the economy. But there are a lot of other signs to say, okay, Jim, unemployment's not a good measure, and it isn't. But how do you know what are the good metrics? They tend to be a little technical. They tend to be things that very few people look at, but they're there. They're not secret. The big one, I think this gets more notice, is an inverted Treasury yield curve. Well, what does that mean? So a normal yield curve, it's like the longer the maturity, the higher the rate. That's common sense. So if I'm going to lend somebody money for a month, I might charge a certain interest rate. But if I'm going to lend you money for 10 years, I want a much higher interest rate because there's a lot more risk, inflation, default, credit risk, who knows what. So a normal yield curve is upward sloping. The longer the maturity, the higher the rate. Okay, right now, yield curves are inverted, which means they're downward sloping, which means the longer the maturity, the lower the rate. Why would you take a lower rate on a 10-year Treasury note than you would on an overnight loan, that's where we are today, by the way. So in other words, this is the big money. This is the institutional money. This is people who know more than central bankers in many cases, betting that interest rates are going to come down a lot. Because if they weren't, that inverted yield curve would make no sense. And so they're betting that the economy is going into a severe recession. Interest rates are going to drop. Now, just to get a little more arcane, there's something called the SOFR futures curve. SOFR is the new LIBOR, there were problems with LIBOR. But these are long-term bets on overnight rates. Treasury is a snapshot of what I think the 10-year rate is going to be, but the SOFR is the opposite. They trade in strips, quarterly settlements that go out 3 or 4 years, 5 years, but the longer ones aren't that liquid. But basically, I can make a bet as to what I think the overnight rate is going to be 1 year from today. That yield curve is also steeply inverted. And again, this is the real, who trades SOFR futures? Well, the institutions and central banks and the big money, in other words. And it's in the data. It's not a guessing. You can look at it. It's publicly available. And it says rates are going to drop steeply in the months and year ahead. So again, these are, when you have an inverted SOFR yield curve, an inverted Treasury yield curve, it's basically the big money betting the rates are going to drop like a stone. Well, why would that be? Well, there are only two reasons. One, a severe recession and a steep drop in inflation. And those two things do go together. One more example, again, I don't want to get too in the weeds, but there's something, the Fed has an overnight reverse repo facility. What does that mean? So the Fed says, hey, give me your cash and I'll give you a treasury bill as collateral, and then we'll unwind it at some point in the future. It's called a reverse repo. So I can call up the Fed, have them send me treasury bills as collateral, give them cash, and they'll pay me interest on that. It's a phone call. I don't have to do anything fancy. Okay. But the Treasury also sells treasury bills at auction, and I can bid on them, and people do. And the yield to maturity on those is lower than the Fed will give you for a phone call. So why would you bid at an auction, take the market risk and get a yield that's lower than the one you can get for a phone call? Well, the answer is that the treasury bill that they send me when I do the treasury facility, I cannot rehypothecate it, meaning I have to hold it, give it back to the Fed when they want it, but I can't give it to you or anybody else. Whereas if I bid at auction, I can take that bill, I can pledge it to UBS, UBS can pledge it to Deutsche Bank can pledge it to Barclays, and they do. But the reason I bid more aggressively for that and take a lower yield, I'm fighting for a lower yield instead of the higher yield I can get for free, is because I need the collateral. That's a sign that there's a collateral shortage, that banks are reducing their balance sheets, they're unwinding derivatives, et cetera. So sorry to be a little technical, but the point is when you look at two inverted yield curves and an auction rate that's lower than what you can get for a phone call, they all say the same thing. Rates are going down, the economy is going to crash, and there's a collateral scarcity, and banks are tightening up their balance sheets. So they're all bad signs. So it reminds me of another indicator, just quickly. Swap rates we have negative swap rates. What does that mean? Well, what is a swap? So I buy a 10-year treasury note and I finance it in the overnight market. So what's happening to me? I'm getting the yield on the 10-year treasury note and I'm paying an overnight real. So I'm receiving fixed, paying floating. Well, sometime in the 80s, in my experience, at some point somebody said, hey, why don't we get rid of the bond? Like, just pay fixed and receive floating. Who needs the bond? The bond's a piece of collateral, but we can have a contract. So that's a swap, a simple form of swap. So I do a swap with Deutsche Bank, and Deutsche Bank says, okay, Jim, I'll pay you the 10-year rate. You pay me the overnight rate. It's exactly the same as if you had the note and we're financing it in the repo market. It's just receive fixed, pay floating. And that's a swap. But if you think of the credit risk, at least with the 10-year treasury note, I got the United States government behind me. If I'm doing a swap with, UBS, I got bank risk. I got some credit risk in the bank. Credit Suisse just failed. So it's logical. It makes sense that the rate I get from UBS should be slightly higher than the treasury rate. The swap rate from a bank should be slightly higher than the comparable maturity of a government security, because the government security is slightly safer than a big bank. Well, right now, that's not true. UBS, or I'm not picking on UBS, Barclays, anybody else in a swap, the rate I get is lower than I get from a 10-year treasury note. So why would I do that? Why would I take the poor credit and take a lower rate instead of a higher rate? Well, the answer is the swap is off balance sheet, and the treasury note, if I own it, I got to put it on my balance sheet. So when you see negative swap rates, meaning the riskier credit is paying you less than the government credit, what it means is that the balance sheets are constrained. I got to do the off balance sheet trade because we can't use up the balance sheets. That's consistent with what we just talked about with the inverted yield curves, which is there's a major credit contraction. There's a collateral shortage, a dollar shortage,